Hi, folks. My name is Dennis Sullivan, and I'm Executive Director for CCBC's Center for Business Innovation. And on behalf of myself and Angela Kivas, our Executive Director, I want to welcome you to our third in a series of workshops. And in this workshop, we're going to be talking about developing a realistic financial plan. That's the key, realistic. All right, it's not wishful thinking. It's a realistic financial forecast for your business plan. In part one of this third workshop, we talk about the legal structures to consider when forming your business. And then in the first workshop, we talked about building a strategic plan. And the second one, we talked about building a marketing plan, all the pieces that you need to develop your business plan. So each year, we at CCBC Center for Business Innovation, we're working with students and alumni who have ideas for how they would like to launch a new product, a new service, a new business, and turn it into something real. We've been doing this for many years now. We enjoy doing it. We enjoy the passion, the innovation that we're seeing, and we want to encourage you and help you do that. So what we've done is set up these workshops to help you work through your idea so that you have a sound, viable, sustainable business product that you can take to market and perhaps even win some money to help you get started as part of our business plan competition. So we're getting into this next piece here, talking about building a realistic financial forecast. Why even bother with this? Do you have to have a business plan? No, you don't. You don't have to have a business plan to get started. In fact, it's not one of the most important things to get started. However, the process of thinking through all these things, the strategy, the marketing, the legal structure are all important. Whether you put it down on paper, that's not necessarily as important, but the process is what's important. For our business plan competition, you do have to submit a actual business plan for the judges to see. Get into that final Shark Tank round. They're going to want to see that business plan, and most importantly, what they're going to want to see is your finances, your forecast. What are you expecting to do? So why bother with this financial forecast? Well, it's going to help keep you on track. It's going to help you think through your costs, your revenue, how this is actually going to work, how you're going to pay yourself, other people, and it'll keep you on track as you progress. How are you doing against that financial plan that you set out? Also, if you are looking to get funding from lenders, investors, from your rich uncle, they're going to want to see your financial plan. What does this really look like? In fact, some judges will skip right over all the commentary that you may provide and go right to the finances to see how you're going to fund your business and whether it is actually going to be profitable. So some things to keep in mind as you are developing your financial plan. Number one, be realistic. All right. This is not wishful thinking. You may even want to do two scenarios, a best case and a worst case, to show the judges that you have actually thought through the possible situations that can occur. And perhaps you may fall somewhere in the middle there, but at least working through that process, if you are anticipating things going well and things do go well, you're ready for it. If things don't go as well as you had planned, well, you're also ready for that with a worst case scenario. So be realistic about your projections. Research what you don't know. If you're not sure, if you're making assumptions here that you're just pulling out of thin air, do some research. There are plenty of resources available. The CCBC library is a terrific resource with tons of tools available to you to see what is happening in various industries where you can see data, figures, projections that are being produced by other companies, analysts talking about what is realistic in terms of cost of sales, sales projections, growth are all going to be important figures for you to do some research on because the judges are going to want to see that. Investors would want to see that. Lenders would want to see that to make sure that what you are forecasting is indeed realistic and there's some evidence to support your ideas. And then you're going to have to revise. You got to come back to that data because you're going to find some things that maybe are not correct. You may have to make some changes as you're working through the numbers and make revisions. Even after you get started, you're going to have to come back and look at those figures to see what needs to be changed and how you can be more realistic based on what may be happening in the market. So I want to give you some examples. I think that would be important for you to see. And what I'll do here is share my screen here with you so you can see some different examples that you can use as you're working through your numbers. And so here's an example with a profit and loss projection that is broken down month by month. And you can see that there's a place here for industry percentages. So if you have different revenue streams, different products, different services that you're offering, you would put that in here. And you can have, based on what is happening in an industry, you can also compare what it is that you're projecting as well. You could also do that for cost of sales. So for each of product or service that you're going to offer, there'd be a different cost of sale associated with that to be able to provide it in the market. That's only going to give you your gross profit. So from there, you're going to want to then determine salary, payroll, if you're using any outside contractors, supplies, repairs, advertising, all that is going to go in here to then determine what your net profit is. And it's important to do this month by month because then you can see if there's any cyclical fluctuations in revenue, expenses, net profit, so you're prepared for it. You may want to start out on a yearly basis and then break it down each month as to what that would look like. It would also be very, very important for you to do a break-even analysis where you take your fixed costs divided by the price minus variable costs. And that's a break-even point that would tell you at what point you are going to break even. You're going to have a net income down here at the bottom of 0. That's not a bad thing because there may be several months, especially in the beginning, or maybe even several years where you are not making a profit at all. So what lenders, investors, our judges are going to want to know is when do you anticipate breaking even? Because after that, then you'll be able to produce a profit. And it's important for you to know that, to know at what point you will be profitable based on your forecast. So break-even point is critical as you're looking at this, and this will help you as this type of chart that breaks it down month by month will help you determine at what point your break-even point may be in that first year. So that's one document. Let me show you another document that may be helpful as well as you're looking at this. And bear with me one second while I pull that up. So this document's similar in that you're looking at your sales at top line there, but it's broken down by year by year. So we have first year, second year. So you have your sales, what you're anticipating, and then cost of goods, your gross profit, and then your salary, outside services, supplies. And so it's year by year broken down. And this may be an easier place to begin. So it may be easier to think about things in terms of annual before you start breaking it down month by month. But what you would want to do is make sure that these two are working closely together because the monthly forecast should add up to your yearly forecast. But this may be a place to start for you, start by year, and then you can break it down month by month. And then notice here we got our gross profit, then our net profit. And then you also have here your net profit before tax, taxes that you would have to pay, net profit after tax, if there's dividends that need to be paid, if there's other partners, other owners involved that need to be paid, that would come in here. And then you have your adjustment to your earnings. So what you are earning at the end of the year after everything has been paid. So this is, the profit actually left in the business that you could use to put back into the business to grow owners' equity, fund the growth for the business. That is key for you to be able to see what you will need and may have on hand to put back into the business to help grow it. Because that's what it's all about at the end of the day, is we want to grow it. We want to continue to see you flourish. So you're going to need the money to do that. Here is another form that I think would be helpful for you. This is one that we actually provide as part of the template for the business plan. And here you can see breaking down pretty simply year by year and also monthly, all on one sheet. You begin up here at the top with year zero. This is what are the startup expenses that you would need before you make any sales to any business. What money are you going to need to get started? And that would go right here. So then you can go into your sales, do it on a monthly basis, then yearly, year 1, 2, 3. Usually judges would just want to see perhaps a 3-year forecast, maybe 5, but 3 years is usually good enough. And it's hard to project out much more than that, especially for a startup. Then you have your total gross sales based on all this revenue streams that you may have, cost of goods, and these may change with your business. For a service business, this may be different, and you would just need to change that in your form here. So the costs are actually reflective of what is relevant for your business. Then you have your gross profit, as you see, and we give you the formulas right here. And then you can determine your gross profit percentage. Ideally, that would be increasing year to year. If it's decreasing, you may want to explain why. Well, we're going to be getting into new markets. Our cost of goods are going to be increasing as we're doing that. That may make sense. You just need to support the reasoning behind the figures that you're providing. And then if you have any sales commissions, supplies, other variable expenses would need to be included there as well. Your fixed expenses, again, these are costs that are not changing with sales. It could be rent. It could be cost of car payments that you have associated with the business. All the things that utilities, if you're doing marketing and advertising that you need to get started with, especially your salary, any wages, excuse me. But so fixed expenses would go there. They're not changing no matter how much sales you do. Variable expenses, they do change with how much sales you're doing. So if you're producing a product, it may be the materials involved, may be the cost of the goods would increase as a variable cost. We have cost of goods specifically up top, but what I'm referring to are other associated costs that would be needed as sales increase. Another good example are sales commissions. If you're increasing sales, you have to pay commissions. Well, those commissions would also increase with the sales. So your variable costs and fixed costs would then make up your total expenses. And then you could see how you could use those figures then to determine your break-even point that we talked about before. So you have those costs right here. Then you can determine a break-even point. Again, that's the fixed cost divided by the price of each unit minus the variable cost of each unit. and that will give you the quantity that you need to produce in order to have a net income of 0. And then you can look at, well, when is that going to happen? You can break it down by month or by year as to when that break-even point is anticipated. So then you can have some ratios generated from this: expenses as percent of sales, the net profit or loss, and all this is before taxes, the net profit percentage, and then adding in your taxes, roughly about 30%, especially if it's an LLC, it's personal income tax. Your tax bracket may be different, so you want to include that figure there. And then you determine your retained earnings. So this is a good template to work with. Again, not everything is, all the expenses are not included here, and that's okay. But what you want to be able to show is that you have thought through this, and you have a rationale behind your forecast. Why are you anticipating the sales that you are? What is that based on? Have you done some market research? Have you done some surveys already? Have you already started generating some revenue that you can show that as a basis for your forecast? So all these things will help you as you are working through your forecast. Again, the key here, be realistic. If you don't know the answer to something, research it. You're going to find yourself revising it constantly. You probably get some feedback from some other people who look at your plan and asking questions that you may need to address as well. And then lastly, keep it simple. All right. You could go on and on with pages and pages of data, sales figures. You don't need to get into all that. What you do need to provide is a realistic projection of what you plan to do on a monthly basis, on a yearly basis, to be able to show that you have investigated, you have thought through all the different costs and possibilities with what you're going to do with the money that you earn in order to grow the business. And that's the key. That's what investors, lenders are looking for, is how are you going to grow? What is that going to look like? And how profitable will the business be? In order for people to support it, they want to see that it's going to generate an income so that they are going to get paid back if they're investing any money in it. The nice thing with us at the Center for Business Innovation, we provide seed money. We do not expect payback. We are giving that to you for you to get started so that you can grow your business. But we are not looking to invest in your business. We want to support you in your growth here as you build your business. We just ask that you become a millionaire, that you remember us and remember CCBC and what we've been able to do for you. So hopefully that helps. If you haven't already, check out the other videos. We have strategic plan, marketing plan, and then part one of our workshop, we were also talking about the legal structure of establishing your business. So look forward to working with you. Look forward to seeing your business plans and more good things to come. Thank you.